Hi friends, today in this video we'll learn about accumulated depreciation. We'll see a situation where depreciation, instead of being charged to the asset, it is recognized in an account called as the accumulated depreciation account, and how to do accounting when we follow the accumulated method of depreciation. An asset is purchased at a cost of rupees 10 lakh with an estimated scrap value of nil on 1st April 21 with a life of 4 years. So the cost is 10 lakh, estimated scrap value is nil, and life is 4 years. Prepare asset account, accumulated depreciation account, balance sheet for the year ended 31st March 22, 31st March 23, 31st March 24, 31st March 25. We follow this accumulated depreciation way of accounting when we treat depreciation as an expected loss and not as an actual loss. You charge off depreciation to the asset when you consider it as an actual loss which has already happened. And in another way of accounting, we don't treat depreciation as a loss which has already happened. Instead, we are treating depreciation as an expected loss which is going to occur, and we keep providing for that expected loss. It is very similar to the earlier method but with a slight difference. Let us see how to do that accounting. Now here, asset is purchased at a cost of 10 lakh, estimated scrap value is nil, and life is 4 years. So the annual depreciation would be 10 lakh minus nil by 4 years. So depreciation per annum or per year would be original cost of the asset 10 lakhs minus estimated scrap value nil divided by life 4 years, 2,50,000 rupees per month. So now how to do accounting for this? Here we'll prepare the asset account. This is my asset account, debit, credit. I'll prepare one more account, accumulated depreciation account, debit, credit. I'll prepare depreciation account as well. Balance sheet. This is liabilities, assets. Let us start. On 1st April 21 we purchased an asset. So on 1st April 21 in asset account we'll write to bank 10 lakhs. The scrap value is nil. Now at the end of the year we have to pass entry for depreciation. We are assuming that we are not going to charge off the depreciation to the asset. Instead, we are going to treat it as an expected loss and provide for it. So in such case, we will pass the entry here in a little different way. On 31st March 22, we will pass the entry depreciation account debtor to accumulated depreciation. So I'll debit depreciation account to accumulated depreciation. 2,50,000 rupees is debited to the depreciation account, and the same amount is credited to the accumulated depreciation account. I'll write by depreciation here. The entry I've passed is depreciation account debtor to accumulated depreciation account. This is the estimated loss which has happened during the year. The next entry we are going to pass is this depreciation loss is debited to the profit and loss account because it is a estimated loss. It has to be debited to P&L account. So on 31st March 22 I'll transfer it to P&L account. I'll write by P&L account 2,50,000. With this, depreciation account will close. For the sake of ease, I'll pass the entries here. 1. Depreciation account debit. 2. Accumulated depreciation account 2,50,000. This is for the estimated loss. Second, this depreciation amount has to be transferred to P&L account, so I'll pass the entry P&L account debit to depreciation account. Okay, so P&L account is debited. Now we come to the balance sheet. Now how to show these items in the balance sheet? If you see the asset account on 31st March 22 carried down 10 lakh. 1st April 22 brought down 10 lakh. So asset account is showing the original cost as the balance now. There is no reduction in the balance. Similarly, in accumulated depreciation account carried down 2,50,000 on 1st April 22 brought down 2,50,000. There is no balance left in depreciation account. It has been transferred to the P&L account. Now we come to the balance sheet. In the balance sheet asset side, we will show asset in the inner column 10 lakh less accumulated depreciation 2,50,000, 7,50,000 in the outer column. So in the balance sheet, we are showing the asset at original cost less the accumulated depreciation. The written down value is shown on the balance sheet asset side, but asset account will continue to show 10 lakhs rupees balance. Accumulated depreciation will continue to show 2,50,000. Instead of showing this item on the liability side, we are showing it as a reduction from the asset. But this is not an actual reduction. It's only for the sake of showing the balance. We are showing it on the asset side as a minus balance from the asset. So this is how we show it in the balance sheet. Let us do one more year. Again, on 31st March 22, we have to now provide 23. The end of second year, we have to again provide for depreciation for the second year. So 31st March 23, again for the estimated loss, I pass the entry depreciation account at R2 accumulated depreciation to accumulated depreciation. 2,50,000 is the amount of loss. Depreciation account is debited, accumulated depreciation account is credited. So we go to the accumulated depreciation account and we are going to write there by depreciation 2,50,000. There is already 2,50,000 balance, another 250 has come to it now. Next, at the end of the year on 31st March 23, whatever is there in the depreciation account has to be transferred to P&L account. We'll write by P&L account 2,50,000. With this, the account will get closed. Now asset account on 31st March 23 carried down. Asset account is maintained at original cost now. On 1st April 23 brought down 10 lakhs. So there is no change in the balance in the asset. If you see the accumulated depreciation account carried down, it is now 5 lakh rupees. On 1st April 23 brought down 5 lakh rupees. Now how do we show it in the balance sheet? This was balance sheet first year. This is balance sheet as on 31st March 23. Asset inner column 10 lakhs less accumulated depreciation 5 lakh rupees now. The WDV would be, the written down value would be 5 lakh rupees. inner column and the outer column. So this is how we show it in the balance sheet on 31st March 23. Let us do for one more year now. Now on 31st March 24, that is the end of the third year, we have to provide depreciation for one more year. On 31st March 24, we'll pass the entry depreciation account at R to accumulated depreciation account. To accumulated depreciation 2,50,000. This amount is credited to the accumulated depreciation account. We'll write by depreciation 2,50,000. Now what happens to the depreciation amount? At the end of the year it is transferred to P&L account. By P&L account 2,50,000. This amount will get closed. So P&L account will be debited with 2,50,000. Now let us balance the accounts. 31st March 24 carried down 10 lakh rupees. 1st April 24 brought down 10 lakh rupees. Accumulated depreciation, it is now showing a balance of 7,50,000, carried down 7,50,000. 1st April 24 brought down 7,50,000. Now if I am preparing the balance sheet as on 31st March 24, asset inner column will continue to show at original cost 10 lakh less accumulated depreciation. It is now 7,50,000. Outer column I'll show 2,50,000. Now same way, if I prepare the balance sheet as on 31st March 25, that is the end of the life of the asset. Asset would be showing 10 lakhs less accumulated depreciation, 10 lakh rupees. The written down value would be 0. Okay. So this is how we'll show it in the balance sheet for the life of the asset. Now, how will the P&L account look like? The P&L account would be very simple. Profit and loss account. On 31st March 22, to depreciation 2,50,000. On 31st March 23, to depreciation 2,50,000. 31st March 24, to depreciation 2,50,000. 31st March 25, to depreciation 2,50,000. So the P&L account, the impact will be the same every year. Now, at the end of the life of the asset, how will we close down the asset account now in our books? This is asset account. This is the accumulated depreciation account. Asset will be showing a debit balance of 10 lakh. And this will be showing a credit balance of 10 lakh. Now, if I want to close the asset, what I'll do is, I'll transfer this depreciation to the asset. To asset 10 lakhs, with this account will closed. Here I'll write by accumulated depreciation 10 lakhs. With this account will get closed. So when at the end of the life of the asset, when I transfer the accumulated depreciation to asset, I'll pass the entry accumulated depreciation account to asset account and close the accumulated depreciation account. If you observe here, debit was 10 lakh, credit is 10 lakh, the account gets closed. If you get some money, you will credit the asset account and the balance would be profit that will be transferred to the profit and loss account. So this was just an introduction to a way of accounting for depreciation, that is accumulated depreciation. The company's law requires you to maintain the asset at original cost, and the depreciation is recognized separately in an accumulated depreciation account. So this is how we deal with depreciation when we are following this way of accounting, in which depreciation is not charged to the asset, instead it is shown in an accumulated depreciation account. Thank you.